We'll check in here in just a few. With widespread speculation that the Federal Reserve may be done raising interest rates, many are asking what this might mean for investors and their investments. Here to help with some practical advice is money and business expert Derek Kinney. Derek, I've been thinking about you lately as there has been so much speculation that the Fed may be done raising rates, because we've talked about this in the past, and you say don't sleep on that window when they finally make that announcement or that decision that they're done doing this. So it's good to have you back. I guess I should start off first, though, by asking you, what impact do interest rates have on the economy? Because, you know, the Fed has just been trying to tap the brakes on the economy without taking it into recession.
Well, Jason, great to be with you and to all of your viewers. The bottom line is interest rates have caused people so much worry because it has caused them not to spend money on things they want. They want the new house, they want to upgrade the car, they want to start a business. If they borrow money, it's costing them more and more money. This was unexpected good news. The economy appears to be growing faster than people expected. Inflation appears to be dropping. And what that means is, at least for the moment, the Fed says we may stop raising rates. Doesn't mean they're going to guarantee they're going to start dropping rates, but just the fact they said they're going to stop rates brought in an entirely new wave of enthusiasm that investors have waited for over a year.
Yeah, it's a very big deal. So let's say the Fed has stopped raising rates. We don't know for sure that that's happening yet, Derek, but let's say that they have, okay? What does that mean for investors and their investments right now?
Well, first of all, it's like a Lamborghini stuck in city traffic. The economy has been revving its engine, but it's surrounded by all these energy efficient, small, short moving cars. And once those are out of the way, that Lamborghini can zoom down the highway. And that's what interest rates mean. When those begin to come down, it frees up the economy. People want to spend more money, and we likely will see money on the sidelines begin to come back in. What that means for stocks specifically is typically within 12 months of the last time the Fed raises rates, the S&P 500 is up an average of 14% within 12 months. So it could spell good news for people's 401ks and investments.
Before I get to my next question, just to drill down on that a little bit, I think we've talked in the past too about once we know that they're done raising rates, but before they necessarily start dropping rates, there's that's sort of a sweet spot for when, if you've pulled all your money out of things, that you want to be there because you might see a big run up.
Well, and actually, historically, Jason, that's a great point. It's about 6 months. So historically, 6 months from basically now, earlier, is when the ideal time would have been to put money in. However, if you gradually ease money and if you have money on the sidelines, this could still be a chance to make some money in the market. Keep in mind, though, it's going to be volatile.
Yeah.
We've got crisis in Israel. We've got worries about the presidential election coming up. All of those can weigh on the minds of investors and can cause them not to spend their hard-earned money.
Yeah, those volatile days can make you queasy, too, if you don't have an investment strategy there. As we lead up to the presidential election in 2024, Derek, how does the economy help or hurt any of the candidates as far as you see right now?
Well, bottom line is, typically every candidate running for president, and especially the incumbent, wants the economy to be humming like butter. Joe Biden wants good economic news. He wants good inflation numbers. He wants good jobs numbers. He wants good stock market numbers to show, hey, my policies are working. But the other candidates are going to be criticizing, hey, the market could have been higher. So the bottom line is, historically speaking, doesn't mean it's going to happen. The market tends to be good in presidential years because the incumbent party does everything possible to make sure voters see the economy as a green light operation. So it's going to be interesting to watch, but odds are if rates do start to get cut, we may see a bright spot for the economy next year.
And that could be a bright spot for the incumbent there as well.
That's right.
We'll have to see with that, though. One last thing before I let you go. Someone who's been, let's say, waiting to purchase a home or invest some money because they're worried about interest rates and, perhaps mortgage rates and the economy. What do you tell them right now, Derek?
Well, first of all, don't expect prices to magically drop. Just because interest rates may drop doesn't mean prices will. If anything, they may go higher because now there's more competition, Jason, for those houses. As I've always said, buy in a great neighborhood, buying a house you want to live in and buying a neighborhood that typically has appreciated. Even if you get a higher rate now, 2 to 3 years from now when rates come down a decent amount, refinance, you'll be thankful you bought the house and you have an appreciating asset.
All right, some important ground being covered here. Derek, thanks so much for walking through that with us all. I've been, like I said, I've been meaning to get back to you because this could be significant in the months ahead. Derek Kenney, the CEO of Good Money Framework, thanks as always for being with us.
My pleasure. Thank you, Jason.